Hello everyone, in our presentation we will introduce the case of Baonan Group's hostile takeover of bank and discuss its implications for corporate finance. At the first part, we are going to show the timeline of this case. Firstly, in the outbreak phase. The hostile takeover began in January 2015. At this time, Baonan Group starts buying shares of bank, and then in July and August, Baonan Group became the largest shareholder of bank by raising its stake to 15.04% for 3 consecutive times through leverage risk capital acquisition. Then in September, to regain its position as the largest shareholder, China Resource Holding Co. Limited has once again become the largest shareholder by increasing its stake in bank twice, bringing it to 15.29%. On December 4th, Baonan Group bought further shares of bank and again became the largest shareholder with a stake of 22.45%. On December 17th, bank's management made it clear that it doesn't welcome Baonan Group. On December 18th, bank shares applied for suspension of trading, announcing that it was planning a share issue for major asset restructuring and acquisitions of assets. And then it came to the radicalization phase. In March 2016, because bank management didn't have a poison pill plan, bank looked for the White Knight, Shenzhen Metro Group, in an attempt to introduce external forces against the Baonan Group. But the reorganization plan was opposed by the major shareholder, China Resource. And then in June, bank's shareholders and Baonan Group jointly sent a proposal to the company for the removal of bank's directors and supervisors, which was opposed by bank's board of directors. In July, bank reported to the China Security Regulatory Commission, the Securities Investment Fund Association, and the Shenzhen Stock Exchange for violations of laws and regulations of the Baonan Assets Management Plan. In 2017 January, China Resource, the second largest shareholder, transferred all of its stake shares to Shenzhen Metro and exited bank. At the conclusion phase, in 2017 March, since bank's management has obtained voting rights for the bank equity held by Evergrande, Shenzhen Metro Group has basically become the actual controller of bank. In 2018 April, Baonan Group sold its stake in bank and made a profit of 4.5 billion. Baonan Group's hostile takeover of bank came to an end.
Throughout the courses of from the beginning and the end of Vanke's hostile takeover by Baonan, we have concluded that the hostile takeover has following effects in corporate governance. As a first, hostile takeover help companies change their disparate shareholding structure. From 1993 to the 1997, the proportion of Vanke's largest shareholder was always lower than 9%. Until 2050, the top 5 shareholders held 31.70% of the shares, of which the maximum shareholding ratio was 14.94%, and the minimum shareholding ratio was 1.01%. The controlling shareholding arrangements was extremely disparate. Such a disparate equity structure of Vanke provides an opportunity for the hostile acquirer, seeing the major shareholder of company own a small proportion of shares. The hostile acquirer can obtain the status of first shareholder of Vanke and intervene in management of Vanke under such circumstances. On the one hand, equity distribution avoids the situation that a single shareholder is dominant, but on the other hand, there is a possibility that major shareholders may change ownership at any time. The collision between management and the major shareholders on the business philosophy will lead to the risk of company's operation and have a negative impact on the long-term development of the company. Take Vanke as an example. In this case, if similar problems are found in corporate governments, it's necessary to timely adjust to over-dispersed shareholding structure to establish a stable position of major shareholder investors in the capital market. This will help to avoid the opportunity for the host to take over and will help to build a lasting brand for the company and make it stable.
Let me talk about how hostile takeover helped management of listed companies pay more attention to market value management. One of the factors that led to Baonen's acquisition was that Vanke's share price had been undervalued, which means the real value of the company had been suppressed for a long time. The company is vulnerable to takeover threats in such condition. Therefore, it is not surprising that, as a high-quality and diversified listed company, external capital can gain control of China's largest real estate development company at a relatively small cost. Therefore, a hostile takeover can make the company's management pay more attention to the correct valuation and the management of the company's market value, so as to give small and medium investors the confidence of investment. It is advisable to shift to the market value management oriented by the returns of minority shareholders while enhancing Vanke's market value in the capital market.
Let me introduce you to the part of improved internal mechanism and set up an appropriate anti-accreditation defense mechanism. There is no detailed and explicit description of the anti-takeover policy in Vanke's articles of association, which makes the company in a passive position in the face of the wholesale takeover by the barbarian Baoneng, unable to aid a defense mechanism. Therefore, in the face of hostile takeovers, the company must have anti-takeover awareness and ensure that the company's control rights will not be lost. What's more, it is necessary to make anti-merger plan in advance, improve anti-accreditation defense awareness, set up defense classes, establish a staggered board of directors system, increase provisions restricting shareholders' rights, and reduce the probability of wholesale takeover to reduce the capital risk of the company. In the design of the company's articles of association, the appointment threshold of directors should be raised and the rotation system of the board of directors should be implemented. In this way, even if the wholesale acquirers have any equity, it cannot quickly control the company and play the role of shakes repellent to achieve the purpose of anti-takeover.
Okay, it's my turn. I'm going to talk about that hostile takeover helps companies discover and prevent potential alliances. The company's legal person system has created a separation of powers for the shareholders meeting, board of directors, and the management. However, due to the lack of a unified and standardized model of corporate governance, the dispute over the rights of the internal controller arises at the historic moment. Vanke's board of directors is potentially constrained by both Vanke's management and the shareholders. The board of directors has a weak supervisory function over the management. There has been an alliance between the management and the board, and the alliance between the major shareholders and the board. This is a long-term hazard to corporate governance. Therefore, taking the case of Vanke's hostile takeover as a warning, the company should improve the incentive system so that the management can truly become one of the company's owners, be able to serve the company's long-term development with due diligence. And at the same time, the company should also strengthen supervision to the potential alliances. That's all. Thank you.
This is a summary of the role of hostile takeover in corporate governance. This is a reference list used in our presentation. Thank you so much for your listening.